Zach's Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. This week we're talking about straddling earnings season. Ooh, what does that mean? Now I've got everybody's attention because it sounds like an erotic title all of a sudden. Blame him. He came up with it. Kevin Matris, who is our options expert here at Zacks.com.
Only you, Terry. Only you could put that spin.
No, my mind can't be the only one traveling in that direction. Let me tell you. But with earnings season in full swing, sounds like a great strategy to try to position yourself out in front of earnings reports before they hit.
Right. Yeah, you know, it is. If you expect a big move to occur one way or another, up or down, this is absolutely a fantastic strategy. So, a straddle involves both buying a call and a put at the same strike price at the same time. So you're buying a call option and a put option, and they are both at the money. Now, as you know, with options, you buy a call if you expect the market to go up, and you buy a put option if you expect the market to go down. A straddle, however, is when you are expecting something big to happen. You're not sure which way the market's going to go, but you want to get positioned to benefit no matter what happens. So again, if you believe something big is going to happen, this is perfectly appropriate for earnings season. This is one of the best ways to be able to capture it without having to worry about whether you've guessed right or wrong or not.
Right. So just so we can get a better an image here in our mind, give us an example.
Yeah, sure. Let's just say that a stock was trading at $100 a few days before their earnings announcement. So you decide to put on a straddle by buying one $100 strike call and one $100 strike put. Now, because you only plan on being in this straddle for a couple of days to maybe a week or so tops, I would advocate that you would buy the soon-to-expire options. Now, this is kind of opposite of what I normally say down here because I normally am an advocate of buying more time and I'm an advocate of getting in-the-money options. But that, I believe, is best when you are playing one side of the market, either long or short. But when you're trying to play both sides of the market simultaneously for an event that you expect to happen in the near immediacy, getting the short or the soon-to-expire options is usually the best way to go.
And why is that?
Well, first off, if let's just say that at expiration, right? At expiration is when you're going to recognize its maximum profit potential. Okay. So, at expiration, your profit is the difference between how much your options are in the money minus what you paid for them. So if you don't need a lot of time, this keeps the cost down and your profit potential up. So if you paid $150 for an at-the-money call option that will expire shortly, and another $150 for an at-the-money put option that will expire shortly, your cost to put on the trade was only $300 minus transaction costs and all of that stuff, right? Now, if that stock shot up $10 as a result of a positive earnings surprise, that call option that you paid $150 for would now be worth $1,000, and that put option would be worth $0. So now you have a profit of $700. So let's do the math here. You paid $150 for the call. That option is now $10 in the money. It's now worth $1,000 minus your $150 cost. That's an $850 profit on the call side. The put option is going to expire completely out of the money. So you paid $150 for the put. That is now worth $0. You lost $150. When you add it all up together, there's your $700 gain. Now, if the stock surprised to the downside and you saw a $10 drop, the result is the same. The only difference is that instead of the call option making the money, it's the call option that would lose everything, and it's the put option that would be the most profitable side. Now, as this illustration shows, though, that is why it is so important to make sure that you keep your costs down. If I put that trade on, let's say, for $300 aside, that would be a $600 cost. Now I only would have made $400 as opposed to the $700.
And let's just say the stock did nothing.
Right.
Then what happens?
Yeah, if the stock did nothing, if whatever you were expecting to see happen never materialized. Nothing really happened. What's going to happen with both of those options is that the call is going to lose money, the put is going to lose money. But again, this is another good illustration, because if you keep your costs small, your loss is going to be small. And again, if you keep your costs small, that is going to increase your profit potential. So again, when you're doing these straddles, I do believe getting close to the money is the best thing, because you're only going to be in there for a couple of days to a week tops.
All right, so to kind of put it in perspective, wrap it up nice and neat.
Right.
A straddle is best when it's a short-term trade and you expect a big move in either direction,
Right.
but try to keep your costs in check.
Absolutely.
Right? Okay.
Now, if let's just say that the outcome of this event that you were getting positioned for, let's say whatever the outcome is, now has you believing that a continuation of the up move or a continuation of the down move is now going to be seen, what I would do is I would get out of that straddle, right, because those things are going to be soon to expire, and I would then put on a call option or a put option, whatever your direction is. I would put on one of those positions. At that point, I would go for the in-the-money calls. I would apply the more time principle, and then you can ride that trend for as long as you wish and as long as you believe that it's a good opportunity to do so.
Okay. Got any stocks that we can use to take advantage of this?
Yeah, here's 5 stocks. Looks like I fast-forwarded the screen a little bit early. There's 5 stocks here, and all of these stocks are going to be reporting next week. And what's interesting is that they all have really big betas. So if there is some kind of, spectacular report, whether it be a great miss or a great beat, knowing that the beta is in most instances twice as much as the S&P, you could see an explosive move. So here's 5 companies. You've got Arch Chemicals, Atwood Oceanics, Belden, Starwood, and Mednax. Some of these things look like they could be in for some big movement next week.
Do you currently have this strategy on with any of these?
No, not yet.
Okay, and you got to learn how to work the magic board better.
Yeah.
Sometimes option strategies can be a little bit more technical and a little bit more difficult to understand when you're just listening to people or watching people talk about them. And it's for that reason that we have a text version of this particular strategy on our website at Zacks.com. You just scroll down until you get to the Know Your Options section, and a link will take you right to the text version of this week's options strategy. Just more information to help you know your options. With Kevin Matris, I'm Terry Ruffalo.